With the US central bank likely to continue pulling liquidity out of the system, risky assets like equities might find it difficult to outperform. In such an environment, even retail investors in India should tilt their portfolios more towards fixed income and limit their exposure to equities to about 30 to 50% of their portfolios. These views were expressed to us by Mr. Sandeep Bagla, Chief Executive Officer, Trust Mutual Fund. Mr. Bagla suggests investing in categories like corporate bond funds, short duration funds, and banking and PSU funds with a 3-year horizon. He also explained what the recent policy announcement by the RBI means for debt mutual fund investors. Do watch this interview to learn more. Good afternoon, Mr. Bagla.
Good afternoon, Sanjay. Pleasure to be with you again.
So the first monetary policy review of this calendar year has just taken place. We thought this would be a good time to speak to you and get to understand what these policy announcements mean for debt mutual fund investors. My first question to you is, the repo rate is now at 6.5%. Do you think it has touched the peak in the current rate hike cycle?
See, Sanjay, it's always difficult to speculate, especially about the future. But the market participants believe that given the inflationary trajectory, uh, this level of interest rates should be peakish, if not the absolute peak. However, I think most central bankers who earlier thought that inflation was transitory in nature, suffered a serious setback to their credibility when inflation shot up. And now they want to be very, very clear and sure before indicating to the market that the interest rate cycle is uh, close to its peak. So I think unless we see, and as RBI governor also said, that unless we see meaningful, significant, durable change in inflation downwards, there is no stopping the tight monetary policy. And within that framework, I think 25 basis points here they won't really matter to them. But I think rates are going to be tight for some more time to come.
In what circumstances could they possibly hike rates hereafter?
So, if you look at the stance, it says withdrawal of accommodation, which seems to suggest that we are still in an accommodatory policy regime. So they don't really require anything. They can just continue on this path and they can hike more without having to justify why or why not. See, this concept of neutral rate is a very, it could be a broad range. It might not be one single rate. So one could argue that, from 6.5 to 7 quarter, we are in a neutral territory. Above 7 quarter, it could be hiking or it could be tightening. So it's a very subjective thing, and one cannot really put any formula to it. It is RBI's choice. So I would say that if inflation trends lower than what RBI has projected, they should not hike. But if inflation sort of remains firm, and there's always the angle of CPI core inflation. Core inflation is something which is still at above 6%. Or so that is something also that will come down only when services inflation comes down. So one can easily cite core inflation being stubborn and hiking rates. So even that is sufficient for RBI to justify their rate hikes.
So a lot of market participants had expected a change in stance, as you said, from withdrawal of accommodation to neutral. Now, could you explain for our viewers what exactly a change in stance would have signaled to the market? What is the significance of this change in stance?
So I think the way it is being interpreted today is that we have already increased effective rates by almost 325, 350 basis points. And now, if we say neutral, uh, probably the market is taking it as a signal that RBI's next move after going to neutral would be cutting rates. So, first of all, I think there can be three broad stances which RBI can take. One is accommodatory, one is neutral, and one is tightening. So we are talking about removal of accommodation. So we are still in the accommodatory phase as per RBI's definition. So neutral doesn't mean that next move will be cut. So I don't think that even if they had gone to neutral, it would have meant something positive for the market on its own. Now people can interpret that, okay, if they have signaled that's neutral, they will not hike anymore. But frankly, if they want to, control inflation, and they are serious about it, they should actually go to neutral or tightening mode. So I think market was slightly misinterpreting the impact of the change in stance. And anyway, that stance never changed. So we will never know.
So the view now is that rates will remain elevated for a long period of time. Do you agree? And for how long are rates expected to stay up?
So one thing we have noticed, Sanjay, is nowadays that the interest rate cycles have become more compressed in the sense that in terms of time, the gap between tightening and accommodative has come down. So earlier we used to have long phases of each stance. Now people believe that liquidity will be tight for the efficient transmission of the monetary policy, and RBI has already given an average of 5.3 inflation for the year. So I would say about 3 to 4 months at least interest rates will be high, 3 to 6 months. Uh, the short end of the curve is dependent on RBI rate and the liquidity. The long end of the curve is more dependent on inflation trajectory and inflation expectations. So these two should be viewed separately. When we say interest rates will remain high, we mean the shorter end of the curve will remain elevated because RBI will not cut down interest rates in a hurry. But the long end of the curve can behave independently. And if the 10-year yield sees that, if people see that the inflation is trending lower, it's quite possible that the 10-year yield can come lower. So if you look in the US, in the US, the overnight rates are much higher than the 10-year yield. There would be a gap of almost 130, 140 basis points. So already the 10-year is believing that, is building in possibility of rate cuts as early as the second half of this financial year or the calendar year.
Okay. So, how far away are rate cuts? Because a lot of people want to bet on around rate cuts. Any guesses around this?
So, Sanjay, policy making and economics are all matter of making choices. So, in the same condition, one can justify keeping high rates. In the same conditions, one can justify keeping interest rates lower. And we have seen central bankers lag by quite a few policies in terms of hiking rates, also in terms of cutting rates, also. I would want to say that I don't have a very strong conviction on when the cuts will happen, but market feels that there'll be a cut during this calendar year, maybe two cuts, and that could come in September or December quarter. And primarily, market is weighing two things. One, RBI has said that it will we will experience a growth of 6.4%. Market participants believe that it will be below 5.5%. So the growth will be far lower, and inflation also will be far lower than 5.3%, which RBI is projected. People are between close to 475 to 5. So there will be a 50 basis points lower inflation and a 100 basis points lower growth. In that scenario, it will be difficult for RBI to keep rates high. And when inflation is low and growth is really slowing down, people expect that an RBI would cut rates in set rates according to the emerging economic realities.
So the key numbers to watch out for are GDP growth and inflation.
Absolutely.
Uh, which debt mutual fund categories should a new investor entering the markets now invest in? How should he go about making this choice?
So, one good thing is that uh, everything in debt markets are valued on a daily basis or mark to market on daily basis. So if investors invest today, they will be investing at the elevated yield levels because all the portfolios in fixed income mutual funds are mark to market. So today you could get a pretty decent yield, which is sufficiently higher than inflation in, let's say, even in liquid fund. But if liquid funds are used for transactional purposes, so that basically a replacement or substitute for, let's say, something like savings account. But if we are talking about slightly longer maturities, let's say in 3 years, one can get the tax benefits also, which reduce taxability of the funds in a very effective and significant manner. So, if somebody wants to remain in 3 years, I would suggest that medium level funds, medium duration funds like corporate bond fund, banking and PSU debt funds, or even short term funds. These are very good because over a 3 year period, definitely we believe that interest rate cycle will reverse and we will head lower. Not lower as in when the COVID happened, when interest rates really crashed, but low as in lower end of the normal range which India follows. So we will probably head towards that. Markets are very keen that it will happen fast, but one can be patient and you can enjoy and lock in at the current yields, uh, which would be perhaps anywhere between 7 to 7.5, and you can hold on to the assets for 3 years in, let's say, a banking PSU or a corporate bond fund or a debt fund, and maybe a certain part should be allocated to long duration gilt funds also, because they could gain a lot when interest rates come down and they have a capital appreciation. I
Okay.
think people should stay away from credit funds, floater funds, because they don't have a very clear positioning, or we don't know how they will perform even if interest rates come down.
So if you have a 3-year horizon, then go for these three categories which you mentioned: corporate bond funds, short duration funds, and banking and PSU funds. What if somebody has a 6 to 12 month horizon?
Then I think money market funds or short duration funds are the ideal funds. Here you are not taking undue interest rate risk or credit risk. Even if interest rates were to edge up slightly, one's returns will not be dented because market is already building in some rate hikes. So it's already building the prices. So if even if interest rates go up, there won't be much difference to your investment returns. Uh, so money market fund or short term fund would be ideal.
A lot of investors want to enter longer duration funds. And even you suggested one could take exposure to them. Is there any risk in entering those funds?
Yes, the risk is that if interest rates keep going up, then they will eat into your interest income. So that is the risk. And but if one is sure that it starts investing on a periodic basis, with you sort of time it with the rate hikes, and if there's a rate hike, you increase your allocation after a couple of days. That will work well with a slightly longer horizon, because one, you are entering at lower and lower prices, and when yields come down, when interest rates come down, then bond should appreciate. The only caveat to this story is, of course, that if interest rates keep going up every year, year after year, then there's a problem.
And what kind of horizon should one have for investing in longer duration funds? And how much exposure should one take to these funds? About what percentage of your portfolio?
So, first of all, the fixed income portfolio should have at least 60 to 70% weightage in the overall portfolio. Over the last 3 4 years, it's quite possible that because equities did better, the weightage has moved in favor of equities. I think first that part of the equity weightage should be corrected to normalize to 30%. 70% should be in fixed income. Also, long duration funds, I think, should be about 20% of the fixed income portfolio. So overall, maybe 15% of the portfolio could be there, and horizon should be anywhere between 1 to 3 years.
Why do you suggest a 60-70% allocation to debt funds? I thought one should have the bulk of one's investments, depending on age, risk appetite, etc., in equities and less in debt funds or fixed income.
So I agree. That is the conventional thought. But if you realize that a lot of money might be put in bank deposits or could be in insurance company with insurance companies, so you should count all of that as a part of your fixed income portfolio. So why I'm saying 60-70% at this stage is key. See, whenever interest rates are hiked or liquidity conditions are tightened, it is difficult for risky assets to do well. Now, US has a balance sheet of let's say $8.5 trillion, which is going to run down by almost $1 trillion every year for the foreseeable future. So that amount of money is going to go out of the system. So if you were to really account for the FPI outflows in equities, maybe that could be one reason why FPI inflows are not happening and FPI outflows are happening. Also, given the economy is expected to slow down, otherwise, what is the point of increasing rates? And if economy will slow down, then demand for the company's sales will also come down. So company sales comes down. So and anyway, most people will agree that India is a far richer market compared to other markets. And in the last post-COVID scenario, when liquidity has gushed in, India has become richer than where it was. So even by their own historical standards and by compared to other markets, India is fairly rich on both sides, on both accounts. So I think it will be prudent to bring down the exposure a bit to a manageable 30%. Where now, of course, if you have a higher risk appetite, you could take it to 50%. But I do believe that there's a good possibility that if interest rate hikes continue globally and liquidity tightens, and I think that is a reality which we cannot do away with. If that happens, then risky assets will have a problem.
One final question, sir. Are there any mistakes that fixed income investors should avoid at this point of time?
So, I have only the past to, identify mistakes. And in the past, investors have made mistakes running after yields in trade funds, which are inherently illiquid because the underlying market is not there. And also, it requires a different kind of skill set and information to monitor the credit portfolios. So I think credit funds, while they might appear, good by recent historical returns or by the portfolio yield, I think investors should stay away from that. And anything which you can't understand, something like floating rate fund, which have underperformed in most scenarios, they should be avoided. Otherwise, I don't think any major correction is required.
Thank you very much, sir. It has been a useful and insightful interaction. I'm sure our viewers will gain immensely from it. Have a good day, sir.
Thank you.